Preface. A short sketch of the author of this essay on mutual banking. William B. Greene (1797–1877) was a prominent figure among the Massachusetts idealists during the middle of the 19th century. He was more than 6 feet high, slender, somewhat high-shouldered, but with an erectness brought from West Point, where he had been a cadet though not a graduate. He had served in the Indian Wars in Florida, and his whole bearing was military and defiantly self-assertive. Greene became a Unitarian preacher and retired to a small country parish. He was a member of the Massachusetts Constitutional Convention of 1853. Later he left the ministry and went to Paris until the Civil War recalled him. Offering his services to Governor Andrew, he was made colonel of the 1st Massachusetts Heavy Artillery. In 1849 he wrote a series of newspaper articles, which were afterwards published as a pamphlet under the name of Mutual Banking. They have been pronounced the best exposition of finance ever written in the English language during that period. In the following pages this pamphlet appears somewhat reduced from the original. The reader is cautioned that Greene's use of the word usury designates not only the excess of interest permitted by law, but all interest whatsoever. When the last edition of Greene's Mutual Banking was printed in 1895, several plans of currency reform had just been proposed by the 3 political parties of that time in USA, and in the preface the question was asked of the leaders of those parties which other followers of Proudhon had asked before. Why is not the credit of a bank's customers as good a basis for currency as that of the bank itself? This question has been partly answered by that provision of the Federal Reserve Act of 1913 by which Federal Reserve currency can be issued in exchange for the rediscounted notes of the customers of member banks. This is a distinct step forward, as it supplies the machinery for expanding mercantile credit, directly, and gives rise to a hope that in future, a move would be made to decrease the cost of this credit. The reader is requested to read the scheme and constitution of Proudhon's Bank of Exchange and People's Bank. Unfortunately these banks could not function because Proudhon was sent to jail in connection with the defamation of President Bonaparte. We intend to publish these in future along with a short biography of Proudhon, who is the originator of the mutualistic idea. Publisher's note. Industrial as well as banking joint stock companies are the biggest props of the capitalistic system, based as it is on the profit incentive. The state controls the economic life of the people through the power of issuing currency and credit. To understand rightly how capitalistic government, in order to suit its own interest, increases and decreases the prices of commodities by the withdrawal and the issuing of currency, this book will be very helpful. In these days we have seen how inflation in currency has hit the consumers and profited the bankers and the industrialists and given scope for black marketeering. The stabilization of prices of articles of day-to-day use not only creates confidence in business circles, but it also provides no chance for exploiters and black marketeers to take undue advantage of real or artificial scarcity of goods. Nobody will hoard goods when there are no chances of undue fluctuations and instability of prices, and thus leading to profits either way. Besides, our bankers, on account of the facility to create credit not only with their own money but with that of their creditors and debtors, squeeze high rates of interest from needy parties which are generally desirous of increasing production. If anyone carefully looks into the balance sheets of banking concerns, it will be found that banks are making greater profits than industrial concerns. The banks get deposits at the rate of 1 or 2% interest and charge their customers from 5 to 8%. Due to their big turnover, they make exorbitant profits. We have seen that some of the deposit banks in USA and UK have made enormous profits in pre-war times, from 50% to 150% or over. The object of the mutualist bank is to advance money on sound personal guarantee on their future earning or production, even without the mortgage of property at the rate of 1% interest per annum. This amount of interest covers the whole expenditure of the establishment and leaves something to be carried forward to reserve funds. Besides, loans on low interest would give impetus to honest industry, and it will also help to increase employment by creating efficient demand. It is very difficult in these days to borrow money from banks on high interest for honest and enterprising concerns. Even on pawning the securities or estates, and so what to talk of owners of small workshops and craftsmen, who have very little of fluid capital and hardly sufficient capital to pledge securities. In order to give some idea of how a mutualist bank, giving loans on nominal interest of 1% can be successfully run, we have undertaken to publish this book. We hope that it will be widely read, and we have priced it low, so that it will be within easy means of students of economics and small producers to purchase a copy. Mutual Banking 1. Value. Let us first explain the difference between legal value and actual value. 1. It is evident that, if every bank bill in the country should suddenly be destroyed, no actual value would be destroyed, except perhaps to the extent of the value of so much waste paper. The holders of the bills would lose their money, but the banks would gain the same amount, because they would no longer be liable to be called upon to redeem their bills in specie. Legal value is the legal claim which one man has upon property in the hands of another. No matter how much legal value you destroy, you cannot by that process banish a single dollar's worth of actual value, though you may do a great injustice to individuals. But if you destroy the silver dollars in the banks, you inflict a great loss on the community. For an importation of specie would have to be made to meet the exigencies of the currency, and this importation would have to be paid for in goods and commodities which are of actual value. When a ship goes down at sea with her cargo on board, so much actual value is lost. But, on the other hand, when an owner loses his ship in some unfortunate speculation, so that the ownership passes from his hands into the hands of some other person, there may be no loss of actual value, as in the case of shipwreck, for the loss may be a mere change of ownership. The national debt of England exceeds $4 billion. If there were enough gold sovereigns in the world to pay this debt, and these sovereigns should be laid beside each other, touching each other, and in a straight line, the line thus formed would be much more than long enough to furnish a belt of gold extending around the earth. Yet all this debt is mere legal value. If all the obligations by which this debt is held were destroyed, the holders of the debt would become poorer by the amount of legal value destroyed. But those who are bound by the obligations, the tax-paying people of England, would gain to the same amount. Destroy all this legal value, and England would be as rich after the destruction as it was before. Because no actual value would have been affected. The destruction of the legal value would merely cause a vast change in the ownership of property, making some classes richer, and, of course, others poorer to precisely the same extent. But if you should destroy actual value to the amount of this debt, you would destroy about 13 times as much actual value machinery, houses, improvements, products, etc. as exist at present in the state of Massachusetts. The sudden destruction of $4 billion worth of actual value would turn the British Islands into a desert,